Hi everybody, we are starting chapter 6 today, and chapter 6 is all about CVP, which stands for Cost, Volume, Profit, Relationships, and Analysis. So if you've been waiting for your chance to do math and use your calculators and get away from, just for a little while, our magic 3 and process costing and job costing and applying overhead, this chapter is your chance. Okay, so there's a couple of assumptions that we have to make when we're using CVP. And again, we'll talk about what CVP is in a couple of slides. But to simplify, so what CVP allows us to do is make quick decisions and quick calculations for decision making, for planning, for budgeting. We do not use CVP for financial statement preparation. It's a decision-making tool, and therefore it is not reported externally on our financial statement. So this is purely internal, truly a managerial accountant's tool. So some assumptions that we have to make when we're using CVP is that our selling price of our products, whether we are selling a single product or a multi-product company, our sales price is constant. We are assuming that costs are linear, meaning that they are following the same pattern. So our fixed costs, we know, are fixed in total over a period of time. Our variable costs, we know that in total of our variable costs increase and decrease in accordance with our quantities. And we also know that our variable cost per unit stays constant. If we have a multi-product company, we are going to assume that the mix of products sold remains constant. And then when we are using CVP, what we are ultimately doing is using our contribution margin income statement. You probably forgot all about that because we discussed it very, very briefly in chapter 1, and then I didn't test you on it. So we'll do a quick introduction of the contribution margin income statement as well. And again, because this is a tool for internal purposes, typically you do not see your contribution margin income statement reported externally. Okay, so we can use CVP to look at and explain how changes in activity will affect our contribution margin and therefore our net operating income. So here you can see an example of our contribution margin income statement. We start with sales minus variable expenses, which we know have a direct relationship between activity levels, in this case sales, equals our contribution margin. So our contribution margin is what is left over after you take out your variable expenses, and it tries to cover fixed expenses. You take fixed expenses out, and what you're left with is net operating income. So this is our contribution format income statement, or contribution margin income statement. This looks different than our traditional income statement. Do you remember the line items in a traditional income statement that you would see on the financial statements? Yes? Awesome. So sales minus cost of goods sold equals gross margin, gross profit, minus selling and administrative expenses, you're right, gives us net operating income. So now, instead of organizing our expenses based on how we accumulate them and how they're incurred, we are organizing them based on behavior. All right, contribution margin, we already said, is the amount left over or remaining from sales revenue after our variable expenses have been deducted. And we're first using it to cover fixed expenses. If there's any remainder, that goes into net operating income. So if contribution margin is higher than fixed expenses, we know we will have a profit, positive net operating income. All right, so let's look at some of the relationships between these line items. So first of all, when you make a contribution margin income statement, you'll see your totals, right? Total sales revenue minus total variable expenses gives you total contribution margin, minus total fixed expenses gives you total net operating income. But then you might also see two more columns. So far we're just looking at one additional column. and that is expressing sales revenue on a per unit basis, expressing variable expenses on a per unit basis, and expressing contribution margin on a per unit basis. So what this is ultimately saying is that my sales price, for every unit that I sell, I'm charging $500. For every unit that I sell, it's costing me $300 in variable expenses. Remember, my variable cost per unit does not change, and therefore I'm left with $200 to try and cover my fixed expenses. So this is what I call per unit contribution margin, or my unit CM, unit contribution margin. So if I'm looking at RBC Racing Bicycle Company, it says that they need to generate at least $80,000 in contribution margin in order to break even, right? So if I have a contribution margin of 70,000, that won't be enough to cover my fixed expenses. I will end up with a loss. So anything above 80,000 is good news, depending on, of course, what your goals are. So now I look at, all right, what does my contribution margin income statement look like if I sell 400 bicycles? Again, at a sales price of $500 per unit, variable expense per unit 300, and CM per unit of 200, and I have $80,000 of fixed expenses. It looks like net operating income equals 0. I call that my break-even point, right? I'm just breaking even. I've covered all of my expenses. I don't have a profit. I don't have a loss. I've just broken even. And that's important to know. So if I keep that in mind, and I can, by the way, express my break-even point in terms of unit sales and in terms of total sales revenue. So I can say, well, my break-even point is 400 bicycles, right? My unit sales. How many units do I need to sell to at least break even? So I have in my mind as a manager that I need to sell at least 400 just so I don't have a loss. Or if you're talking to an accountant, they might say, well, we need to have $200,000 in sales revenue to break even, right? So at least that's my minimum. If I sell one more bike past my break-even point, right? Break-even was 400. If I sell 401, watch what happens. My net income increases by my contribution margin per unit, right? So at break-even, what else did you notice? Let me go back. What else did you notice at break-even? Yes, my net operating income is equal to 0. What I notice is that my contribution margin, what's left over from sales revenue after I take out variable expenses, my contribution margin is equal to my fixed expenses. So I've just covered them. Now, if I add one additional unit of sales, I have $500 more of sales revenue, $300 more of variable expenses, right? Because the more I sell, the higher my variable expenses. And now I have an additional $200 left over to try and cover my fixed expenses. So for every unit past break even that I sell, my net operating income will increase by my unit contribution margin, right? So if I sell 402 bikes, what will net income be? That's right, 400. What about 3 bikes? Yep, 600. You got it now. Okay, so the nice thing about CVP and the contribution margin income statement is that every time we want to do a quick analysis, like what will happen if I sell 800 bikes, I don't have to go in and make an entire income statement. I can just use the relationships that I know. I could use my CM per unit. There's also CM ratio and variable expense ratio to do what I call a quick and dirty analysis, right? So in this case, if RBC sells 430 bikes, what will net operating income be? Well, that's 30 above break even, right? So I can say I will make $6,000, 30 units above break even times my CM per unit, right? I've already covered fixed expenses at 400 bikes. Now everything that I sell beyond that, I'm going right to profit with my contribution margin. So understanding those relationships is going to be really important. Will you be able to get through the chapter by recreating a contribution margin income statement for every single problem? it's questionable, right? Because you won't always be given all of the information to do that. Okay, so how do I express my contribution margin income statement in an equation? Well, it isn't an equation, right? Except it's a vertical equation, right? So if I flatten it out, I have profit, which is the same as net operating income, equals sales minus variable expenses minus fixed expenses. And then you can see in parentheses, I have sales minus variable expenses. That is equal to my contribution margin. So I can rewrite this so many different ways. I can say profit or net income equals contribution margin minus fixed expenses. I can look at this in terms of units. I can say, how do I get total sales? Sales price times quantity minus how do I get total variable expenses? Variable cost per unit times quantity minus fixed expenses. If I break that down even further, right? So that's what I'm doing here. 401 units times sales price 500, 401 units times variable cost per unit 300. My fixed expenses don't change, and I never express those in terms of or on a per unit basis. Do you know why? It is because my fixed expenses in total never change, but on a per unit basis, they have an inverse relationship. And part of my CVP analysis requirements, my assumptions say that I need to keep my per unit stagnant. Okay, so now again, here is my, so P, I would rather write SP there. SP times Q, that's my total sales minus variable cost per unit times Q, that's my total variable cost, minus fixed expenses. I can rewrite this again. So see how there's a Q in both of these little equations within my total sales minus total variable expenses? If I factor out that Q, I'm left with sales price minus variable cost per unit times quantity minus my fixed expenses. And what is my sales price per unit minus my variable cost per unit? My contribution margin per unit. So I can rewrite this again and say contribution margin per unit, or unit CM, times the quantity of units that I sell minus my fixed expenses. I've just created a quick and dirty contribution margin income statement for internal purposes. Okay, and here it is. Sales price per unit minus variable expense per unit is my unit CM. So if I scroll down, profit equals unit CM times quantity minus my fixed expenses. Okay, and there we go, profit 200. Let's do a practice problem. Wish you were here. If the contribution margin is not sufficient to cover fixed expenses, what happens? All right, so anytime you have any of these questions, I always like to make in my head or write it down on paper. I'm more of a paper person. I like to fill in numbers. So let's say my contribution margin is 17,000 and my fixed expenses are 19,000. So now I'm picturing in my head, what does the contribution format income statement look like? Sales minus variable expenses gives me CM. CM minus fixed expenses gives me NOI, net operating income. So if my contribution margin is below fixed expenses, that means I'm going to operate at a loss. So C would be my answer. How about this one? A $2 increase in a product's variable expense per unit. Let me move this out of the way. Accompanied by a $2 increase in its sales price per unit will what? So if I'm selling a product for $10 and it costs me $5, how much am I making on each unit of product? That's right, I'm making $10. So my unit CM is, excuse me, 10 minus 5, I'm making $5. So my unit CM is $5. Now if I increase my sales price to 12, and then I increase my variable expense per unit to 7, I'm still making $5, right? So if I'm incrementally increasing both at the same rate, this $2, then nothing is going to happen. Nothing will really change, all right? Unless I'm looking to change the quantity of units sold, this will not decrease profits. It will not decrease my contribution margin. That stays at 5. It will not increase profits because my CM is staying the same. It will not cause a loss, again, if we're only looking at those two variables and not at quantities. All right, let's do this practice question, CM per unit. Gravinsky Corporation, a company that produces and sells a single product, has provided a CM income statement for November. So I have sales revenue, $319,200, and that's based on me selling unit sales, 5,700. Then I have variable expenses, that gives me contribution margin per unit, minus fixed expenses gives me NOI. If the company sells 5,300 units, what is its net operating income? All right, and again, this is quick and dirty, it's an estimation. This is not reporting in my financial statements. So you're given everything here. So if you had the time, which you will not on the exam you have to know the shortcuts. Sometimes you won't have all the information. You really need to know the relationships. If you had the time, you could say, all right, what's my sales price per unit? $319,200 divided by 5,700. Minus what's my variable cost per unit, $188,100 divided by the 5,700 units. So I can get sales price per unit and then multiply it by the new number of units, 5,300. I could get variable cost per unit and multiply it by the 5,300. I could rewrite this entire thing. I don't want you to do that. I want you to think about, how does this all work together? How can I make this as quick and simple as I possibly can? Right, so again, I will have another video on how to do these actual problems in the PowerPoint. But instead of recreating an entire income statement, I can take some shortcuts, right? So my current contribution margin at 5,700 units is $131,100. My contribution margin per unit, if I take $131,100 divided by 5,700 units, is $23 per unit. I'm not changing my sales price, right? There's no mention of that. And I'm not changing my variable cost per unit. So my contribution margin per unit is going to remain constant in this example, which means instead of calculating total sales minus total variable expenses gives me total contribution margin at 5,300 units, I can go right to my total contribution margin at 5,300 units using my CM per unit. So if I'm making $23 per unit, that's left over after all of my variable costs, and I am selling 5,300 units, that means I will have $121,900 left over after I take out variable expenses. And then I try to cover my fixed costs. So I take fixed costs out, $106,500, and I get net operating income of $15,400. Any questions? Post them in the discussion board. All right, practice problem using the CM ratio. So the CM ratio, I'm getting a little bit ahead of myself, and this will be coming up in the next couple of slides. What is my total contribution margin if sales volume increases by 20%? All right, so right now I've got total sales minus total variable expenses gives me total contribution margin minus fixed expenses gives me net operating income. I do not have my sales price per unit. I can't calculate that either because I don't know how many units I'm selling. I don't have my variable cost per unit. I don't have my contribution margin per unit. But what I can do is I can use ratios. So when you see a contribution margin income statement, you usually see the totals, right? Total sales revenue minus total expenses gives you, contribution margin minus fixed expenses gives you NOI, minus variable expenses gives you contribution margin. Then you have your per unit column, right? Here's my sales price minus my variable cost per unit gives me CM per unit. And then you have this third column, which I have here, where my sales represent 100%. And then I take out what I call a variable expense ratio. And that leaves me with a contribution margin ratio. And what that ratio means is for every $1 in sales, 30 cents in this case is left over to try and cover my fixed expenses. So I got the 70% for my variable expense ratio by taking my variable expenses and dividing by my sales price. And then when I take 70% out of 100, I can get my CM ratio. I could have just calculated the CM ratio by taking my contribution margin divided by my total sales, right? So I would have gotten the same thing. So we're going to cover this in a couple of slides. And there are lots of different formulas that you can use depending on what you're given to calculate your CM ratio. So my CM ratio is 30%. So for every $1 of sales, 30 cents is my contribution margin. So if I'm increasing sales by 20%, right? And I did a quick calculation over here, but here's my proof. When I increase my sales by 20%, I'm basically multiplying sales, current sales, 400,000 by 1.2, right? I'm adding on to the 400,000. Right here, I'm just showing you, here's the 400,000, and I'm increasing it by 20%. So my new sales will be 480,000. My CM ratio is 30%. So for every $1, 30 cents, 0.3 goes towards my contribution margin. So my CM at $480,000 of sales revenue should be 144. All right, I did a little quick calculation over here, right? So I didn't have to do all of this, but I just said, all right, my sales price isn't changing, my variable cost per unit isn't changing, and my CM per unit isn't changing. So if everything stays the same, if sales increase by 20%, my contribution will also increase. My contribution margin will also increase by 20%. So here's current contribution margin times 1.2, right? I could have said 120 plus 0.2 times 120, but I just did this all in one. Here's my 144, right? So here's my proof using that CM ratio. Okay, CVP graph. So again, this is a very math-based chapter. We are using formulas and equations, and we're using graphs. So we've seen a couple of different graphs. We're back at RBC Company, and they've created a contribution margin income statement, a what-if analysis for what will net operating income look like if they sell 0 bikes, 200 bikes, 400 bikes, and 600 bikes. And remember, 400 bikes were their break-even point. So let's put this in a graph. Our x-axis is always the number of units. Our y-axis is always our dollars. We saw that before. So step one is to draw a horizontal line parallel to the x-axis to represent total fixed expenses, right? So my fixed expenses for RBC were $80,000. And then I start at that $80,000 point, and I am increasing this blue line. I'm increasing for every additional unit that I sell. I'm going up by my variable cost per unit. So you may or may not remember this. Again, I didn't test you on it, but we spent some time on it. This is my total cost line. So it's fixed cost plus my variable cost. And because it's really a mixed cost line, right? Because I am increasing, I know that I have some variable costs in there, because as I increase in volume, my total cost is increasing. But if I don't sell any units at my volume 0, I still have to pay that fixed cost of $80,000. So I am representing, or trying to represent, my contribution margin income statement. And so I need sales in here too, right? So this blue line is really my fixed expenses plus my variable expenses. I need sales revenue. So the slope of this line is going to be 500, right? Change in Y over change in X. So every additional unit that I sell, I'm going to increase my sales dollars by 500. That was my sales price per unit. So if I sell 0 units, I am operating at a loss of $80,000 because I still have $80,000 of expenses. But my slope of my total sales line is steeper, right? You would rather climb the blue mountain than the green mountain. The green mountain is steeper, which means my sales price is greater than my variable cost per unit, right? So I'm making money every time that I sell 1 unit. And where these points touch, where total sales equals total cost, is my break-even point. All right, so here's my break-even point. Again, I can express it in terms of units or in terms of dollars. So 400 units to break even or $200,000 in sales. And then I have these 2 areas. So the area above my break-even point, where my sales line is above my total cost line, I call that my profit area because I've already broken even and now I'm going to start to make money. The area below the break-even point is my loss area. So if I sell less than break-even, I'm operating at a loss, negative net operating income. I can also make a simpler graph called a profit graph. All right, so this tells me just net operating income. So when I sell 0 units, I'm at negative, this should really be negative 80,000. I think those are my fixed costs. And then here's my break-even point. See where profit, net operating income is 0. My break-even point is 400 bicycles, right? So this is just a simpler form of CVP. Okay, let's do some practice problems on my CVP graph. Which of the following is correct? The break-even point occurs on the CVP graph where total contribution margin equals total fixed expenses, right? So total profit and total expenses, that doesn't mean that we're at break even, right? I'm at break even where total revenues equal total expenses, right? Not total profit. Total profit equals total fixed expenses, no. So profit, they're talking again about net operating income. Total variable expenses equal total contribution margin, doesn't work. All right, let's do some other practice questions here. Moss Feet Shoe Corporation is a single product firm. Company is predicting that a price increase, so a sales price increase next year, will not cause unit sales to decrease. So the number of units that you're selling will stay the same, but you're increasing your sales price. And when you're increasing your sales price and your fixed cost per unit is staying the same, your contribution margin per unit is increasing, right? What you're making after you take out your variable costs. And if your unit contribution margin is increasing, your CM ratio is increasing, right? CM ratio is contribution margin divided by sales. So my contribution margin ratio is increasing. And what happens to my break-even point? If I'm making more per unit sold, and this is not affecting my unit sales, and unit sales really have nothing to do with the break-even point. The break-even point says, where do I need to sell? How many units or what are my sales dollars in order to break even? It doesn't matter how many I'm selling now or in the future. My break-even point is used for analysis. So if I'm making more per unit, I can sell less units to break even, right? Because I'm making more. So my contribution margin ratio will increase and my break-even point will decrease. So the answer will be A. All right, CM ratio. So now we're getting into it. The CM ratio, use it to compute changes in the contribution margin and net operating income resulting from changes in sales volume. All right, so my contribution margin ratio and the variable expense ratio. So contribution margin as a percentage of sales, we call the CM ratio. So I can take total contribution margin divided by total sales. For RBC, my total contribution margin was 80,000 divided by my total sales. So 200,000. So my CM ratio was 40%. Again, for every additional dollar in sales, 40 cents will be used to try and cover my fixed expenses. I can also use my per unit calculations in calculating my CM ratio. The ratios will not change if your sales price doesn't change and your variable cost per unit doesn't change, right? Because my per unit is the same ratio as my totals. How do I get from per unit to total? I multiply sales price per unit times quantity. I multiply variable cost per unit times quantity. I multiply contribution margin per unit times quantity. You're multiplying them all by Q, right? So the ratio will not change. So for RBC, my contribution margin per unit, I'm making $200 per unit divided by my sales price per unit equals 40%. So I get the same calculation there. Then I also have my variable expense ratio. So same type of formula, except instead of using CM, I'm using variable expenses. So I can use total variable expenses divided by total sales. So it's a percentage of sales. So for every dollar that I make in sales, 60 cents I'm using to spend on expenses, variable expenses. And I can also do the same thing on a per unit basis. So variable cost per unit divided by sales price per unit will give me the same 60% ratio. So these are all of the ways that you can calculate CM ratio. And then we'll look at how we actually can use it, right? So CM ratio can be equal to total CM divided by total sales. CM ratio can be equal to total sales minus total variable expenses, which is CM divided by sales. CM ratio can be my sales price per unit minus my variable cost per unit. That's my CM per unit divided by my sales price. Or my CM ratio can be 100% minus my variable expense ratio. So there's so many different ways that you can calculate CM ratio at 40% here. Okay, so how can we use it? Applications of the contribution ratio. So if RBC increases sales from 400 to 500 bikes, we're increasing sales revenue by 50,000. So yes, could I go in and remake the entire income statement like they did here to determine my new profit? Yes. Or could I just say, all right, here's break even. I'm making an additional $50,000 in sales, multiply that by my 40% ratio, and that gives me $20 in additional net income, right? So that's my new net operating income. Here's another practice problem. What is the CM ratio for Coffee Klatch? So you're given a lot of data here. Average selling price or sales price per unit of a cup of coffee, $1.49. Average variable expense per cup, 36 cents. Average fixed expense for the month is $1,300. Average of 2,100 cups are sold each month. So a lot of additional information in there you need to weed through. What is the CM ratio for Coffee Klatch? CM ratio could be my total contribution margin divided by my total sales, but that gives you some extra work. Or you can use your per unit. So you're given sales price per unit and variable expense per unit. And from that, you can calculate your unit CM. So $1.49 minus 36 cents gives you your unit CM $1.13 divided by your sales price, $1.49. Gives you 0.758 or 75.8%. Okay, so another application, if you're looking at the equation, right? So anytime we're using CVP, you can make your contribution margin income statement, or you can use your equation. So here's the equation for that additional $50,000 in sales. So my profit or my net operating income is equal to my CM ratio times my sales dollars, right? That's going to tell me what's 100,000. That's my total contribution margin, right? For every $1 in sales, I make 40 cents. So for $250,000, I'm left with $100,000 of contribution margin minus those fixed costs of $80,000 gives me $20,000 of profit. Okay, I'm going to stop there. I will load the work that I did for Rovinsky and the Schister problem. And I hope you have a great day, and I'll see you at office hours on Tuesday and Thursday, 9 to noon.